IndusInd Bank has been an outperformer in the past 3 months, not only within the banking pack, but also with respect to the benchmark Nifty50. Steady execution in Q4, promising outlook for FY23 and undemanding valuations make us reasonably confident that the stock has further scope for re-rating. The bank in the past was rocked with issues in the corporate book, run on deposits following the Yes Bank fiasco, and in more recent times, whistleblower allegations on procedural lapses in the MFI book. All that is behind with a high-yielding book dominated by vehicles and microfinance, steadily improving liability and waning asset quality concerns as the economy improves. We see sustenance of its high interest margin and expansion in return ratio. Steady Q4 was marked by improved advances growth, 10 basis points sequential improvement in net interest margin, and decline in provision on the back of improving asset quality. Gross and net slippage declined sequentially thanks to the improvement both in microfinance and vehicle finance. Net slippages for the quarter gone by were at 0.6% of loans versus 0.9% the previous quarter. IndusInd Bank continued its aggressive write-off in the retail portfolio. The gross NPA declined quarter on quarter from 2.48% to 2.27% and net NPA from 0.71% to 0.64%. And the book has a provision cover of close to 72%. In addition to that, the bank carries standard contingent provisions worth 3,328 crores, which is 1.4% of advances. Bank's restructured book saw a sequential reduction of 1,359 crores and moved down to 2.6% from 3.3%. Collection efficiency of the vehicle portfolio was 90% in March. The MFI collection efficiency on standard book, excluding restructured, improved to 99.1% and management expects the gross NPA of MFI to move back to pre-pandemic level of 2.5%. Exposure to stressed telcos has now come down from 3,000 crores to 1,850 crores. The special mentioned accounts also declined sequentially from 84 basis points to 59 basis points. On improving outlook for two key segments and the complete overhaul of the corporate book with better rated assets, the bank expects credit costs to almost halve to 150 basis points of loans in FY23. Thanks to the ebbing concerns on the microfinance portfolio, growth is gradually making a comeback. On a sequential basis, advances grew by 4.6% in Q4, with strong growth in large as well as small corporates and retail growth coming in from microfinance as well as non-vehicle retail and early signs of revival in vehicles. The bank has three strong pillars: vehicle, MFI and gems and jewelry, and it expects all engines to fire in FY23. IndusInd is looking at a strong growth highway, advances growth in the range of 15 to 18% between FY21 and FY23, thereby pointing to a strong FY23. The secret to maintaining industry-leading NIMs is not only the high lending retail book, but also an improved composition of deposits and the resultant decline in cost of deposits and cost of funds. Now, in the past year, cost of deposits and cost of funds have declined by 43 and 46 basis points respectively. IndusInd Bank has seen a steady surge in deposits despite dropping rates. Overall deposits grew by 14.6% in FY22 and the bank has more than comfortable credit to deposit ratio of 81%. As this excess liquidity gets deployed, we see that as a positive kicker for interest margin. The low-cost CASA has grown faster at over 17% and the CASA share has remained stable at 42%. The retail deposit share of 41% has a lot of catching up to do in the coming years. Like most peers, IndusInd Bank is also spending on technology and people to capture market share at a time when shadow bankers have been rendered weak. This is reflected in the marginal spike in the cost-to-income ratio. IndusInd Bank's comfortable capital adequacy at 18.42% with CET1 ratio at 15.96% and stable deposit base prepares the ground for a strong FY23. In the context of this growth outlook, valuations look undemanding, leaving room for further re-rating. Of course, there's a key risk to watch out for, which would be COVID impacting earnings as well as asset quality.